Hello and welcome to this reading in corporate finance on cost of capital. Cost of capital refers to the rate of return that the providers of capital require to contribute to the firm. We can also think of cost of capital as the opportunity cost of funds for the providers of capital. Unless the return offered by a company meets or exceeds the rate that could be earned elsewhere from an investment of similar risk, a potential supplier of capital will not provide capital to the company. Without any further ado, we'll directly move into the LOS requirement. To raise a capital, a company can either use equity or debt funds, or sometimes an instrument may also have features of both equity and debt. An instrument that is used to obtain financing is called a component, and each component has different required rates of return, which are known as the component cost of capital. The weighted average of the costs of various components used by the company is known as the weighted average cost of capital or the marginal cost of capital. The weighted average cost of capital is the expected rate of return that investors demand for financing an average risk investment of the company. A company's WACC can be calculated as follows, where WD is the weight of debt, RD is the return on debt, T is the tax rate, WP is the weight of preference shares, RP is the return on preference shares, WE is the weight of equity, and RE is the rate of return on equity capital. We'll now look at a simple example that will illustrate the calculation of WACC. So I would want you to pause the video, solve the question. Okay, it's just a simple plug and play of formula and then look at the solution. There's nothing really too tedious or overly testable that you really need to be hung up on it. Weight of debt is 40%, so 0.4. Return on debt is 7%, so 0.07. The tax rate is 30%. We all know that why we are deducting tax rate. The reason being that the interest expense, similar to depreciation expense, provides a tax shield known as interest tax shield. Because of that expense, our overall tax burden is lowered by the 1 minus tax rate times the interest expense, and therefore we need to calculate the post-tax cost of debt, which is calculated as the weight of debt into the return of debt into 1 minus t. Similarly, weight of preference and weight of equity and their returns. So we calculate WACC as 7.86%. LSB requires us to evaluate the effect of taxes on cost of capital from different capital sources. So the most important tax consequence is because of debt, because it saves interest, and because of interest expense, we have something known as an interest tax shield. So let's assume that a company pays $50,000 in interest for a year. This is an expense that the company is allowed by tax purposes to reduce the taxable income. As a result of this $50,000, assuming a 30% tax rate, it reduces profits after tax by only $35,000, and $15,000 of interest tax shield is obtained. Tax shield as in 50,000 into 1 minus 30%. So 50,000 into 30%. 50,000 into 30%. That's the tax shield. While calculating the cost of debt, we do 1 minus tax rate. But while just calculating the tax shield, we calculate it by the amount multiplied by the tax rate, which is 50,000 times the tax rate. Adjusting for interest tax shield, the real after-tax cost of debt is not really 50,000, but 35,000. Tax savings are only realized on payments to holders of debt instruments. Payments to preferred and common stockholders are not expensed on the income statement and therefore do not result in any kind of tax savings. And therefore, while calculating WACC here, we never did 1 minus t here or here because they do not provide any tax shield benefit. And therefore, as a result, we can say that only debt has an impact of taxes on the cost of capital, which is adequately captured in this formula. I repeat again, if you take down a pen and paper and calculate two income statements, okay, prepare two dummy statements, one with interest expense and one without interest expense, you will see that the difference between the PAT, the profit after tax, of both those statements are as a result of the interest tax shield, which is 50,000 into 30%, $15,000 in our case. Because of that tax shield, the entire cost of capital is affected, and it is as if I never repaid $50,000. I actually repaid $35,000 only, and therefore my cost would be considered as $35,000 and not $50,000, and therefore it does affect the cost of capital. The target capital structure. In determining the cost of capital, the WACC, we would ideally want to use the weights of various components in proportion to their employment in financing new project. If we assume that the company has a target capital structure and it will raise funds in line with its target capital structure, we must use the target capital structure in calculating WACC. The target capital structure is the capital structure that the company aims to maintain. The weights used in the calculation of WACC are the proportions of debt, preference shares, and equity shares that the firm hopes to achieve and maintain over time. A simple transformation of debt equity ratio into weight of debt is simply using the following formula. If information about the target capital structure is not easily available, we can use the weights in the company's current capital structure as a dummy, as a proxy. The weights of the various components should be based on market values. Another option is to examine trends in the company's capital structure over time or statements by management regarding the company's capital structure policy to estimate the target capital structure. Let's look at an illustration that will help us to calculate the capital structure weights. Clearly, we can see that the weight of debt is $10 million divided by the total capital of $50 million. That of preferred stock is 2 by 50, which is 4%. And the balance going to common stock, which is 38 by 50, which is 76%. We all know that here, whenever percentages are involved, the sum of the percentage obviously has to be 100%. If these three total 50 million, then the combined percentage of the different weights will also add up to 100% or 1. Let's see. 20 plus 76 plus 4. It always adds to 100%. We'll now estimate the proportion of capital. The market value of Becker Incorporation's debt is $25 million and the market value of its equity is $35 million. So what is the weight of debt? The total capital of the company is $60 million and therefore the weight of debt will be 25 by 60. Similarly, the weight of equity will be 35 by 60. Again, the sum of both will obviously be 100%. Okay, 100% if you're taking in percentage terms and 1 if you're taking in percentage point terms. If the company announces that a debt equity ratio of 0.6 reflects its target capital structure, what weights should be assigned to debt and equity in calculating the company's WACC? So they are saying that the debt to equity is 0.6 and therefore the weight of debt will be 0.6 by 1.06 because they are saying that the debt by equity should be 0.6. So if we take on a ratio form, if debt by equity is 0.6, so equity is 1. Nothing means 1 in the denominator. So the total capital is 1.6, 1 plus 0.6 and therefore the weight of debt is 0.6 by 1.6 which is 0.375%. Similarly, weight of equity will be 1 minus 0.375, or we can also calculate it as 1 divided by 1.06, which will give us a 62.5% weight. From an exam testability, please be on top of this in fact question 2 of this example. It is my suspicion that something related to this sort will definitely be tested on the exam in some way or the other, where you need to possibly and properly evaluate the debt and equity. Okay, this question, okay, estimating the debt, this is such a plain vanilla question that this can hardly be tested on the exam. Okay, and what happens that when such a question is tested on the exam, students tend to overthink. Student tends to think that such an easy question can never come on the exam, and I totally agree. But if it's given, then please do not overthink. If it's there, it's there. Just tick on and circle the oval sheet and move on. Okay, OMR sheet and move on. Circle the oval and then just move on. There's nothing more you can do. But these kind of questions are really tricky. Okay, so your slight mistake, okay, and your options, okay, the 3 options, the other 2 options will definitely entertain, okay, possible mistakes. And whenever we see an option that matches with some figure that is on our calculator, we just tend to rush and tick it. We do not even spend 10 seconds to think about it. Correct? What mistake did we make? So anyways, okay, so keep all this in mind and then go ahead. If you want, you can pause this slide, spend a couple of minutes here, and then just move ahead. A company's marginal cost of capital increases, it raises the additional capital. As it increases more and more capital, the incremental, in fact the term marginal, what does the term marginal means? The term marginal means incremental. So if we keep on raising more and more capital, the incremental capital that we'll raise will be raised at higher cost, such that our incremental cost of capital increases. The company prioritizes investments in projects with the highest IRRs. As more resources are invested in the most rewarding projects, remaining opportunities offer lower and lower IRRs. This fact is represented by an investment opportunity schedule that is downward sloping. Also, this happens because most firms must pay a higher cost to obtain higher amounts of capital. The more a company borrows, the greater the risk it will be unable to repay its lenders, and therefore the higher required return by its investors. The optimal capital budget occurs at the point where the marginal cost of capital and the investment opportunity schedule intersect, as shown in the diagram below. Again, from an exam testability, you are not supposed to understand the preparation of the diagram. You will not be asked to draw diagrams on the exam. Okay, this I just gave for the purpose of completeness. However, I personally do not like diagrams at all, because diagrams होने से mind में एक और tension रहता है कि उसको बनाने कैसे बनाएंगे and this and that. Okay, so you should not take load for diagrams. Okay, you should not. This is the optimal investment decision and everything is fine, but preparation of diagram को लेके आप अगर अपने mind में एक और stress डालोगे, okay, so that is something that really is not really helpful. Okay, so please keep that in mind. The company must raise capital at the given marginal cost of capital and undertake all projects to earn the given IRR to the left of the intersection point, because these projects enhance shareholders' wealth given the cost of financing them. On the other hand, to raise capital in excess of the optimal capital budget, that is to the right of the intersection point, the firm will be required to incur a cost of the capital that is greater than the return on available investments. Undertaking these projects given the MCC will erode firm's value and shareholders' value going ahead, and therefore such projects must never be undertaken. The role of marginal cost of capital in determining the net present value of a project. The WACC is the discount rate that reflects the average risk of the company. When we choose WACC as the discount rate to evaluate a particular project, we assume the following things. The project under consideration is an average risk project. The project will have a constant capital structure which equals the company's target capital structure throughout its life. The cost of capital for a particular project, a specific project, must reflect the risk inherent in that project, which will not necessarily be the same as the risk of the company's average project. If the risk of the project under consideration is above or below the average risk of the company's current portfolio of projects, an adjustment is made to the weighted average cost of capital. Specifically, if a project has greater risk than the firm's existing projects, the WACC is adjusted upwards. The reverse is as true. If the project has less risk, the WACC is adjusted downwards. The marginal cost of capital, or WACC used synonymously, adjusted for the project's level of risk, plays a very crucial role in capital budgeting because it is used to calculate the project's cash flows, the present value of the project's cash flows. Instead of 7%, the rate should be 8% or 6% or 9%. Because of a 1% increase or decrease in the rate, there will be a massive increase or decrease in the NPV of the project. And therefore, those discount rates, really need to be forecasted with utter precision. There can be a 1 or 2% deviation in the cash flow. That is okay. But the deviation in the cost of capital, deviation in the discount rate, deviation in the denominator is actually an unpardonable offense for a financial analyst, for a CFO. He really needs to forecast each and every rate with utter precision that reflects the real risk that is inherent in the project and that the company will be undertaking going ahead. The cost of fixed rate capital is the cost of debt financing when a company issues a bond or takes a bank loan. We'll be discussing two approaches to estimate the before tax cost of debt. The first being the yield to maturity approach and the second being the debt rating approach. In the yield to maturity approach, the bond's YTM is a measure of the return on the bond, assuming that it is purchased at the current market price and held till maturity. It is the yield that equals to the present value of the bond's expected future cash flows to the current market price and is expressed by the following formula. And the legend is as follows. All these numbers, as you can see, all these legends, they will actually form a part of your numbering on the calculator. The PMT is on the calculator, P0, that is the present value, the current price is on the calculator, RD, the I by Y is on the calculator, N is on the calculator, and FV is also on the calculator. So what you will be given is, you will be given 4 of these and you might be asked to calculate P0, the present value, or you might be given everything but not the rate, and you might be asked to calculate the rate of return, correct? So clearly that's just a simple plug and play of formula. This equation actually assumes that we are considering semi-annual pay coupon bonds. So the interim cash flows are discounted at the rate divided by 2 here. If we assumed annual cash flows, it would have been R, but this formula actually assumes that the cash flows are made on a semi-annual basis. Let's look at an example that will help to calculate the cost of debt using the YTM approach. The company issues a semi-annual bond to finance a project. A 10-year bond, par value of 1000, 6% coupon rate, assuming that the bond was issued at 1010.30 and that the tax rate of the company is 40%. Calculate the before and after tax cost of debt. Before moving on to the example, I'll just digress a bit. It's a fixed income related topic, but I think it's good for you to have a revision at this juncture. What they are trying to say is that I am offering 6% coupon. The coupon is always as a percentage of face value. So 60, 60, 60 I'll be getting for the next 10 years. And in the 10th year, I'll be getting 1060 and 60 for the interest and 1000 as my principal. This would have been the normal scenario. But here we are said that the company makes semi-annual payments. Because of the semi-annual I'll not be getting 60, 60, 60. I'll be getting 30, 30, 30. And that to 20 times, because in 10 years, there are 20 half years. So I'll be getting 30, 20 times. And at the end, the last cash flow would be 1030. And I'll be discounting all that to arrive at the price of the bond, because the value of an asset that I should be paying is the present value of all those future cash flows. Because of this present value, we need to calculate the cost of debt, because until and unless you know, okay, what cost, what is the rate of return, how will you evaluate a bond? That is first issue. Second, you can see that the bond is trading at a premium. A premium means that the bond is trading at a price that is higher than the par value. So clearly what is happening, that in the market, other opportunities might be trading, okay, at 5%, 5.5%, let's say, but this company is offering you 6%. Okay, so as a result, if other avenues were providing 5.5% and this company is providing you 6%, it will obviously be charging you higher price, and therefore the bond is trading at a premium of $1,010.30. Coming back to corporate finance, just a simple plug and play of formulas. Okay, the present value is this, the par value is this, the periodic payments are 30, as I said, the number of discounting periods will be 20, and using our calculator, if you feed all these numbers, we'll be getting a rate of I by Y of 2.931%. And now obviously, since the cash flows are semi-annual, this rate is also semi-annual, and therefore the yield to maturity annual rate will be twice this rate, which is 5.8%. This is the before tax cost of debt, because we never in this entire place did we ever consider 40% anywhere at all. कहीं भी क्या आपने 40% को कंसिडर किए कैश फ्लोज के टाइम पे, प्रेजेंट वैल्यू, फ्यूचर, कहीं भी तो कंसिडर नहीं किए ना आपने. देयरफॉर द आफ्टर टैक्स कॉस्ट ऑफ डेट विल बी दिस minus 40% or this into 60%. I personally like the second one. Okay, this into minus 1 minus 0.4 क्या मतलब? Okay, that is a really bad way of thinking. Okay, so this into direct 0.6. However, students want that, you know, everything is expressed in terms of formula. I'm like, ले लो formula चाहिए तो ले लो अभी. But the best way, okay, and the most simpler way is 5.8 into 0.6. This will give you a 3.52%. Semi-annual yield is, as I said, is multiplied by 2 to calculate the bond's YTM on a BEY basis. BEY as in bond equivalent yield. We now move on to the debt rating approach. When a reliable current market price for the company's debt is not available, the before tax cost of debt can be estimated using the yield on similar bonds that also have similar terms to maturity as the company's existing debt. For example, HUL wants to issue a 10-year bond. Okay, and the bond that HUL is issuing is a AA rated bond. Okay, so the before tax cost of debt that an investor needs to use to evaluate, or the company needs to use for the purpose of paying coupons and this and that, really can be with respect to similar AA rated bonds in the market which have same maturity and same features. Okay, so if we assume that the comparable AA bond in the market was being rated at, let's say, 10%, then I can use that 10% as a benchmark in order for my bonds. Let's see an example with respect to the debt ratings approach. So here Alexter has capital structure that includes a AAA. AAA is the highest category of bonds as per the Standard and Poor Index, okay, rating agency. And similar 10 years maturity comparable AAA rated bonds have a maturity of 6%. So therefore I'll be choosing a 6%, and therefore my after tax cost will be 6% into 0.6, that is 3.6%. When using the debt rating approach, adjustments might have to be made to the before tax cost of debt of the comparable company. The relative seniority and security of different issues affects ratings and yields, and these factors needs to be incorporated when selecting a comparable bond and using its before tax cost of debt as a proxy for the cost of debt of the company being studied. There are a couple of issues in estimating the cost of debt. The first is the fixed versus floating rate debt. The cost of fixed rate debt is reset periodically based on a reference rate, usually the LIBOR, and is therefore more difficult to estimate than the cost of a fixed rate debt. For floating rate bonds, analysts may use the current term structure of interest rates and term structure theory to estimate the cost of debt. Debt with option-like features. If currently outstanding bonds contain embedded options, an analyst can only use the yield to maturity on these bonds to estimate the cost of debt if he or she expects similar bonds with embedded options to be issued going forward. If, however, option-like features are expected to be removed from future debt issues, one should adjust the YTM on existing bonds for their option features and use the adjusted rate as the company's cost of debt. Non-rated debt. If a company does not have any debt outstanding to be rated or yields on existing debt are not available due to lack of relevant current prices, an analyst may not be able to use the YTM or the debt rating approach to estimate the company's cost of debt. Finally, leases. If a company uses leases as a source of financing, the cost of these leases must be included in the cost of capital. We now move on to preferred shares. A company promises to pay dividends on preferred shares as a specified rate, and these rates are known as the preference rates. When preference shares are non-callable and non-convertible and has no maturity date, it pays dividend at a fixed rate, the value of the preferred stock can be calculated as A by I, where A is the dividend and I is the interest rate. The curriculum follows this nomenclature and therefore I have put on this, where the value of the preferred stock is the preferred stock dividend per share and the cost of preferred stock. Rearranging the equation, we can calculate the cost of preferred stock as follows. Just an algebraic manipulation. Let's look at a simple example with respect to determining the cost of preferred stock. So the dividend per share is 10%, the current market price is 100, therefore the rate will be 10 by 100, 10%. Nothing overly testable at this point. We'll now move on to approaches to determine the cost of equity. The cost of equity is the rate of return required by the holders of capital, the common stock. Estimating the cost of equity is really difficult due to uncertainty in future cash flows that common stockholders will get in terms of their amount and timing. There are three approaches commonly used to determine the cost of equity. The first is the capital asset pricing model. The capital asset pricing model is a single factor model that shows that the risk that shareholders bear can be based on only one factor, and therefore that is compensated using the market risk premium. Therefore, the required rate on equity shares are the risk-free rate plus beta times the market risk premium. Beta of stock measures the sensitivity of the stock's return change to the change in market returns, and therefore we multiply it by the expected risk premium. A simple plug and play of this formula can definitely come. Now there can be some of the tweaks in the question. Okay, what tweaks? That instead of market risk premium, I've said no, this is the market risk premium. Okay, the difference is the market risk premium. Okay, what they can do is they can directly give you this, or they can give you RF, beta and the market return. So you need to calculate expected return on equity by subtracting the market rate of return minus the RF, as in subtracting the RF from the market rate of return. So this difference, okay, what we are talking here, okay, is actually the market risk premium. this difference that we are talking is the market risk premium. Expected return on market minus RF is the market risk premium. So beta times the market risk premium plus the risk-free rate of return. We'll be discussing more on CAPN, okay, in portfolio management. So simple plug and play of formula, okay. The equity risk premium standard 10%, as I said. So they can just give you the equity risk premium. So 10 times 1.3, 13 plus 6, 19%. Or they could have given you equity risk rate or the market rate of return, okay, or the equity rate of return or whatever, okay. Then you would have to do 10 minus 6, that is 4, times 1.3 plus 6, okay. So that is 5.2 plus 6, that is 11.2. The equity market risk premium, that is RM minus RF, can also be estimated using a survey approach where the average of forecasts of financial experts is adjusted for stock specific systematic and non-diversifiable risk. We will be learning about systematic and unsystematic risks in portfolio management. The DM approach. The dividend discount model asserts that the value of the stock equals to the present value of expected future dividends. We'll be using the constant growth dividend discount model, also known as the GGM, the Gordon growth model, in which dividends grow at a constant rate to determine the cost of equity. While this model is studied in greater detail in fixed income, at this stage we just need to know the following equation, which is used to calculate the price of the stock and also helps in determining the cost of equity. Where price is the current market price, D1 is the next year's expected dividend. Obviously ये तो कोई आपका प्रिसिशन के साथ बोल नहीं सकता ना. So therefore ये आपका D1 जो होगा expected dividend होगा next year का, correct? And so on. On rearranging the equation, we can get RE as D1 by P0 plus G. The growth rate G is a very important, okay. So you can calculate RE as RE divided by D1, RE equal to D1 divided by P0 plus G. Also, the growth rate is a very important variable in this model. There are two ways to estimate the growth rate, and the growth rate can be calculated using 1 minus D by the earning per share into ROE, where D by EPS is the payout ratio and 1 minus D by EPS is the retention ratio. Therefore, the growth rate can be calculated as the retention ratio into ROE. Let's now look at an example on dividend discount model approach. Diamond Incorporation has an earnings retention rate of 60%. So if there's a retention rate of 60% means a payout ratio of 40% and a return on equity of 20%. So your growth rate will be 60% times 20%, that is 12%. Its next year's dividend is 2 and current market price is 40. So your D1 by P0, 2 by 40, okay, that is 5%, and 12% we calculated as the G. So 5% plus 7% is the required rate of return on the equity stock, which comes to 17%. We finally come to the last method, which is the bond yield plus risk premium approach. The bond yield plus risk premium approach is based on the assumption that the cost of capital for riskier cash flows is higher than that of less risky cash flows. Therefore, we calculate the return on equity by adding a risk premium to the before tax cost of debt, and is calculated as follows. The return on equity is the return on debt before tax plus a risk premium. A simple plug and play of formulas will give you the answer of return on equity with the help of bond yield plus risk premium approach. That risk premium in terms of the exam and the CFA level 1 exam going ahead, these inputs will be given and you just need to calculate RE. So if return on equity, we need to calculate, okay, the rate on the yield to maturity on long-term debt of a company is, let's say, 10%, and the risk premium is estimated to be 8%, then the cost of equity will be 10 plus 8, that is 18%. But in real life, this 10 and 8, that is what you need to forecast. Okay, that is what a real analyst needs to do. But at level 1, they are trying to build a base, at least making you aware of the different terminologies so that going ahead in real life and practical scenarios, you are able to forecast these things with precision. And all these valuation actually does come ahead in level 2. This is all for this video. Thank you.